everybody, and welcome. My name is Sam Chaplin. I am the Associate Portfolio Manager here at Penobscot Financial Advisors, and today I'm joined by Jim Bradley, who is our Chief Investment Officer. And we've put together a little chart pack here for you today that we're going to look at some of the themes we've seen in the year so far to date, and the things we'll be looking at going forward. And there's a more complete version of this commentary on our website. But for now, we're just going to go through and have a little talk.
Sure. Thanks, Sam, and welcome everybody. Looking at what we just got through in the first and second quarters of the year, I started out by trying to look for some sense that we might have some positive trend toward normalization going on. One of the places I stopped was at Apple's website. They've got some neat data out there that you can download, and I was able to download and chart their navigation routing requests specifically for the state of Maine, and using kind of January as a benchmark. You can see how around the middle of March, those requests dropped down pretty significantly as nobody was traveling. And they've come back mid-May to their pre-crisis levels, their pre-lockdown levels. And since then, they've pretty much doubled, which is encouraging. I think that's probably still a little bit shy of what you might see as far as a pickup in Maine in the summertime, but still a good step forward. On this next slide here, I've got another website that I was able to get some data off of. This is from Open Table, and obviously they're a restaurant reservation service. You can see back in early April, the percentage of U.S. restaurants taking reservations was at solid 0, and that recovered really nicely up to the 1st of July. Over 60% were taking reservations, which was an encouraging trend. A little less encouraging, though, to see it the following week went down a little bit. And if we want a little bit of a clue as to why that is, we just have to take a look at the next slide, and that's an indication that the U.S. control over the virus is becoming a little bit questioned. You can see the black line, the EU, and how they've seen the spike but flattened the curve pretty effectively. Domestically, we've seen a bit of an upturn. This graph just goes through June 24th, so we're about a month after that at time of recording here. And obviously, for those of you who are watching this in this time period, you know that line on the U.S. side has continued to go up. A little bit of a creep up just recently in the EU as well, but not nearly to the degree that we've done it. There's a lot of argument being put forth that the increase lately has been just due to increased amount of testing. This next slide puts that into a little bit of question, because yes, certainly there has been an increase in testing, but overall the positive test rate, the positives divided by all tests, has, as of this slide, begun to creep up in the US and has gone up pretty significantly since then. You can see the areas that are responsible for it, not surprisingly, areas in the West and the South, like Arizona, Florida, Georgia, and Texas, that have really seen some flare-ups within their borders. So whereas we've got some optimistic signs out there that we're starting to recover from this, we've got some reminders that come up from time to time that we've got a ways to go here, and that this is not going to be a straight line. So, we'll want to be a little bit cautious with our optimism there.
Yeah, Jim, I find it very interesting how quickly these, economic indicators can shift to things like routing requests and, reservation requests, and things that wouldn't have been on any economist's radar a few months ago have now become leading factors for moving the markets. And as you mentioned, we've had this recent spike that's, happened here in the U.S. and starting to see some just recently around the world as well. So this next slide shows us a little bit how that's been manifesting in the markets. So in the teal line here, we have the S&P as you know it, now has turned positive for the year just in the last few days here, which all things considered seems very positive. And that's the headline number you're going to see there. However, this graph shows a little bit of a different story when put up against the S&P equal weighted index. So for those who don't know, the S&P 500 is weighted by market cap. which means that the larger companies have a much larger effect on the index itself since they have higher weightings. However, if you were to equal weight all 500 companies in that index, the average stock would still be down almost 7% for the year. So that kind of tells a whole different story than you might see in the headlines. And we kind of wanted to go into a little bit how the factors that would skew up the headline number versus the equal weighted number. And I think this next slide shows a little bit of how much higher the concentration has become in the S&P over recent years, but also just as a long-term trend. You can see now this table is showing that the top 10 stocks are now weighted almost 28% of the index, which is pretty massive. I think another number I saw recently that highlights this was pretty interesting. It was looking at the largest companies at the end of 2010 versus the largest companies today. At the end of 2010, the largest company in the world was ExxonMobil, which had a market cap at that point of about $340 billion. Today, we're looking at Apple and Microsoft pushing $1.7 trillion. So almost 5 times there on the size of the companies. And, that translates into higher weightings and more concentration in indexes like the S&P as well. And then we look at the next slide and we're going to see that skew where those FANG stocks, you may or not be familiar with them, but the FANG stocks are Facebook, Apple, Amazon, Netflix, and Google. Some of these really big winners at the stay-at-home stocks have just been on a tear this year, up about 33% year to date versus we were saying the average S&P company down about 7. So a huge difference in the story there. It's been interesting to see how, those type of companies were kind of seen as aggressive, on the riskier side of the spectrum a year or so ago. And now that's been totally flipped on its head with, these companies being less susceptible and exposed to the coronavirus demand shock and have really continued to shine.
Yeah, if you had told me a few years ago we'd be using technology stocks as a kind of a defensive play in a portfolio, I would have been very surprised. But here we are, and that's exactly the role they're playing these days. So,
yeah, definition of diversification has changed a little bit. You always want to stay diversified between different companies and sectors and industries. But now there's also this added layer of being diversified between companies that are exposed to the coronavirus type of shocks and those that aren't, the stay-at-home type of stocks that have been rallying as well. So that's something we'll continue to stay focused on. And on the next slide here, Jim's going to talk a little bit about what we're seeing on the fixed income markets.
Right. It's not all about the stock market. I like to also pay close attention to what's going on in the bond markets, the debt markets. And one of the things I look at pretty closely are credit spreads. And just a really simple working definition of what a credit spread is, it's the amount that you're getting rewarded for taking credit risk above and beyond, what you would get on what we'd consider to be a risk-free investment, and specifically U.S. Treasury bonds when we talk about essentially risk-free investments. So if you look at where we are right now, there's a few different ways of looking at it. There's investment grade corporates, which is the teal colored line. There's the purple corporate high yield index, and representing kind of what we euphemistically just call junk bonds. Investment grade is a higher level of credit worthiness, and anybody below that is considered high yield or junk bonds. And then specifically the high yield energy index, that part of the junk bond index that's represented by energy companies in the gold. You can see that particular metric peaked up really significantly recently, and not terribly surprising for those of us who were watching the oil markets last month, and the absolute cratering, unprecedented cratering of oil and gas prices. Those have come back to some degree now. But also looking at just in general, the overall corporate high yield index, you can see that it went up a bit, but in both cases, they've come down pretty substantially. And if you compare them with the spike that we saw back in the global financial crisis of 2007, 2008, you can see that with normal high yield bonds, they didn't peak out as highly, and they've kind of come back down off of those peaks. And I think the big part of the reason for this is the Fed, Federal Reserve, buying these instruments in the open markets, and that's somewhat unprecedented. Back in 2007, 2008, they bought up a lot of government bonds, but not a whole lot of corporate debt. This year, lots of corporate debt, not only investment grade, but also digging down into some of the junk. And that's really what's kind of kept those spreads, those opportunities, as I'd like to look at them, a little bit low. So we're wanting to be a little bit cautious right now when we're looking at how we treat credit risk in our portfolio. And whereas, you see, you can still get a bit of a spread there. It's just north of 5%. That's not all that very different from what you're getting on dividend paying stocks right now, and by and large. And it's, not something that's as likely to go up in value. So with the amount of risk that we're seeing out there, again, just being pretty cautious when it comes to exposing ourselves to credit risk, and we're kind of dipping our toes into that just a little bit at a time to try to get better yields on our overall fixed income portfolio.
Great, thanks, Jim. And as you mentioned, the story of the Fed and fiscal and monetary side this year has just been a main story, pretty unprecedented on both sides. The amount of support we've been getting there, so that'll be something we continue to watch going forward. Hard to say how much of the recent rallies have been a result of that, but the market will still be looking very close at the policymakers and what changes they'll be making the rest of this year and likely into next year. At the moment, it's looking like interest rates are going to stay low for quite some time, and we'll also get some more support looking for another stimulus bill, or at least the market is looking for another stimulus bill in the near future here. So big potential for market movements. So that credit spreads are how we look at valuing on the debt market a little bit. And here on the equity market, the PE ratio is one of the biggest metrics that are used to show what level of valuation companies are at the moment, with price being in the numerator and earnings being in the denominator. Gives you an idea of how many dollars you have to spend for a dollar of earnings. And in this chart here, we're looking at the forward PE ratio, which means the earnings in the denominator are the analyst estimates of the next 12 months of earnings for these companies. So it gives you an idea looking forward how much dollars you have to pay today for how much earnings over the next 12 months. And this is a long-term chart here going back through the mid-90s, and you can see that big bubble in the tech bubble, the late 90s, early 2000s. It showed it a pretty obviously overbought market at that moment. On the flip side, down in 08, you see it sold off way below the one standard deviation move, and that showed a pretty good buying opportunity. And we're certainly watching now, this is as of June 30th, having broken above that one standard deviation move from the average, potentially in overbought territory. The hard part is that in these large bouts of volatility with so much uncertainty, those analyst estimates are pretty wide ranging going forward. At the moment, the estimates for what the S&P is going to be at the end of the year about as wide as they've ever been. So a little bit of a grain of salt, but certainly something to keep watching as we move forward and see how much companies' earnings are impacted and for how long. One area that we get some comfort in is in this next chart here. We're looking at on a trailing basis. So how much are you paying today for the last 12 months of earning as opposed to the forward? And here we're trading right around the long-term averages. Obviously, the last 12 months of earnings may be a little different from the next 12 months, and that's where people make their money trying to figure out what the next 12 months are going to look like. But on a trailing basis, coming into this, did not look like we are in any type of bubble territory. So the next few months of earnings and will be pivotal.
Yeah, it's going back on that point there, comparing where we are now versus 2000, being at a price to earnings ratio, forward price to earnings ratio in the 20s is maybe not quite as concerning as it was back in 2000, because if you kind of consider the flip of the price to earnings ratio, the earnings yield, as being something that we'd want to compare with where else can we put our money, between 20 and 25 times earnings that you're paying for it is somewhere between 4 and 5%, and the earnings yield. And whereas in 2000 that was going up against a safe bet to the 10-year Treasury of around 5 to 6%. It didn't seem quite as defensible back then, but right now, with those earnings yields in the 4 to 5% range, even given the dismal numbers that we see going into the future, that's competing against a 10-year Treasury right now that's only about 0.6% in its yield. So maybe a little bit more defensible.
Agreed.
So in absolute terms, concerning, but in relative terms, maybe not quite as concerning.
Yeah. We also have to keep in mind that large skew of, those stay-at-home winners are trading at 30, 35 times earnings, while the average stock is well below that. So
Good
always something to
point.
keep in mind.
Right. Oh, so now we can talk politics, and certainly the third quarter is going to bring us a lot more of that, isn't it? We're getting closer to November, and we can see a pretty impressive swap in leadership status when it comes to the betting odds as to who's going to win the presidency. Trump was a favored candidate up until right around the beginning of June, and you can see there was a pretty sizable trailing off and a pretty sizable run up in the odds for the Biden vote. So right now, this is just from Real Clear Politics. There, and obviously you can look at these and realize that they can change, but as of today's numbers, the odds look like they're favoring Biden at 60%, and the odds of a Trump re-election, they only have it about just north of 1 out of 3. So that brings up, some degree of, concern from the market standpoint, if only because in the past, and this applies both to Democratic and Republican presidents. When a sitting president is voted out of office, that does tend to bring along some market volatility. The interesting thing is, despite this kind of swapping of places, the markets aren't really reacting with a whole lot of volatility right now, and so that could be a number of things. It's still a few months away from the election, and just about anything can happen. But B, I think there's a pretty significant number of analysts out there that are starting to realize over time that the market is not the economy, and the economy is not the market, and so things that the market may or may not like perhaps an increase in corporate tax rates if the Biden administration were to come in, and they've been pretty straight with the American people about their desire to kind of put that back closer to where it was before the Trump tax cuts, or even something like capital gains tax increases. These types of things the market won't necessarily like, but economically, perhaps they make sense over the long term. And the same thing applies to things like, oversight over and regulation on things like, climate change issues and that type of thing. Short term, industry may not like them. Long term, they may be things that are required to keep the economy strong. So in a lot of those ways, I think that people are kind of shrugging off, where we're going with the presidential election. It might be a kind of a surprise to some people. It was to me, because the conventional wisdom has always been, gosh, market likes Republicans and doesn't like Democrats. But if we go to this next slide here, we see that actually historically the numbers don't really bear that out. Going back to the Herbert Hoover administration, and granted, Herbert was a Republican and started off with some pretty dismal numbers. Just looking at the overall numbers, annualized returns during a 4-year term through the Obama administration, the Republican average was out only about 1.71%, and the Democrat average up about 10.83%. Those numbers on the Republican side should improve a little bit with the first Trump term being accounted for. But, I guess the point that somebody should take away from this is, don't overestimate what a presidential election or what any one administration is going to, have as an outcome when we're looking at the markets, economically and market-wise. The Democrat/Republican, any particular presidency doesn't really seem to have a truly significant impact, a predictable impact one way or another when we're looking at markets or the economy. Well, I always like to end up on a high note whenever possible, and this next chart lends a little bit of hope to what we're seeing right now. This is just one of the analysts out at Bloomberg went back to 1950 and looked at the highest quarterly changes in the S&P 500. So we gained, a pretty significant amount, over 20% in the second quarter on the S&P 500, which puts it solidly into the top few quarters of all times, at least going back as far as we're tracking it for this piece of analysis. The key here is to see that in the quarter following, so in the quarter, arguably that we're in right now, following a big run up, the market has tended to also go up. So it'll be interesting to see if that bears itself out this time. There's no real kind of indication as to causality here, except for maybe just inertia and markets, kind of continuing on a trend. But it can be encouraging to see that at least, historically going back quite a long ways, a good turn deserves another when it comes to the S&P 500.
Thanks, Jim. Good point. Might be a lot of investors thinking, wow, we just dodged a bullet and got bailed out of that big downturn, and maybe it's time to head for the hills. But this chart would show you that that's not been the case historically. And maybe it is just momentum carrying the markets up. There's no reason to think that immediate pullback is in our near future when looking at valuations or looking at these historic returns here.
That's right. We don't want anybody to go into the third quarter thinking that we're out of the woods by any stretch of the imagination. We certainly are being cautious here. There are a lot of things that could go wrong that could really kind of put a dent in the progress that we've made. And so while we're cautiously optimistic that we aren't likely to see anything on the horizon that causes a really big divot back down to where we were, especially given the amount of money that's been poured onto the economy through the fiscal stimulus programs and by the Fed. We're simply looking to diversify out as much of the potential volatility as we can while keeping investors fully invested for what we hope to be a good solid recovery, but on the far side of this when we get quote to normalcy.
Agreed. I think a lot of it comes back to what you mentioned about the market is not the economy, and I think that's more apparent to people now than it has been in recent history. You look at unemployment numbers and those type of economic indicators that look pretty poor versus how the stock market's performed, but always got to keep in mind that the market is forward-looking, and that short-term disruptions may not lead to long-term downturns if they can be corrected. And a lot of uncertainty out there, but that's no reason to get scared and run.
Well said. Couldn't agree more.
All right. Thanks for joining us, everybody. And if you want to see any further commentary, we have it posted on our website and on Facebook, and that dives a little deeper into the economic numbers that we saw in this most recent quarter. Thanks for joining us, and we'll see you next quarter.
Thanks. See you next quarter.
The foregoing content reflects the opinions of Penobscot Financial Advisors and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be construed as investment advice or a recommendation regarding the purchase or sale of any security. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct.
Walking across